1987. I mean, not compared to the ones we got today, but for the time they were troublesome, and it was worrying the bond market, but the stock market didn't care, and the dollar was weakening in 1987. And again, the stock market ignored all that, but the bond market was paying attention, and eventually the stock market crashed after ignoring the rise in bond yields. And in fact, it was the stock market crash in 87 that actually was the catalyst for a major bond market rally that finally took the pressure off of bonds, because we had a crash in the stock market, and I guess people rushed into bonds as a safe haven, and also because they were worried about how the stock market crash might impact the economy. Now, one of the reasons that it didn't have a bigger impact on the economy was because Alan Greenspan. And Alan Greenspan responded to the stock market crash with rate cuts and easy monetary policy, and that actually set the tone for his entire tenure as Fed chair, because that happened right away. He had just taken over the Fed not too long before the 1987 stock market crash. But the way he behaved following that crash is exactly how he handled the entirety of his tenure, which is why we ended up with both a stock market bubble in the 1990s and then a housing bubble in the 2000s, which didn't pop until he got out of Dodge, right? Because Ben Bernanke was Fed chair by the time the housing bubble popped. But all of that was the result of the monetary policies that were really pioneered by Alan Greenspan. Looking at what happened in the rest of the markets. So as I said, bonds went down, yields went up, but it didn't stop the stock market. Although the Dow Jones was down a bit on the week. The Dow was down 0.4%. S&P 500, as I said, new record high, rose about 0.5% on the week. The NASDAQ also had a positive week, led by the rebound in the AI names. Tech stocks that had been beaten down have come roaring back in the last week or so, up just under 0.5%. The small caps, they had a good week. The Russell 2000, 1.3% on the week. But I think the best performers, again, for the second week in a row, were precious metals. Now, gold itself only up about 1%, closed at $4,375 an ounce. Intra-week, we did trade above 4,400. So that's over 10% move from 4,000 support. Silver also rose just over 1% on the week, closed at $64.58. But intra-week, silver traded above $66 on Thursday and on Friday, actually. So closed well off its highs, but still a positive close on the week. And the mining stocks, more gains. The GDX up 1.8%. But what's significant is that it didn't pull back at all after being up 22% last week. So we added another 1.8%. GDXJ, same thing, up 1.6% on the week following last week's 25% rise in the GDXJ. Now, I mentioned last week, Bitcoin went up, but not nearly as much as gold or silver or the mining stocks, but instead of adding to its nominal gains or minimal gains last week, Bitcoin almost gave up all of its gains. It fell 2.7% on the week. Bitcoin, as I'm recording this on Saturday night, I think Bitcoin's just about exactly 63,000. But it couldn't even follow through with back-to-back gains. That's how weak Bitcoin is. And strategy stock was down 5.7% on the week. So even though the NASDAQ was up, even though gold was up, gold stocks were up, strategy was down almost 6%. That's a pretty big drop. Even Stretch, which is the preferred that strategy has been buying back. They've been issuing common, selling Bitcoin to buy back Stretch. And even Stretch was down on the week, closed at 94.78. Can't even close above 95. Remember, strategy's main goal now is to get Stretch back to 100. and it hasn't even achieved that. The yield right now is 12.7%. They're going to have to jack it up again because they're not getting it up to 100. And if they haven't gotten it up to 100 yet, what does that mean? They got to sell more Bitcoin. They got to sell more common stock. That's bad news for common stock. That's bad news for Bitcoin. Really, I don't know what's holding Bitcoin up. I think it should have dropped a lot more by now. Now, it's not rallying, and I think a lot of people are interpreting this to mean that it's getting ready for a big move up. I saw on X, somebody pointed out that Paul Tudor Jones had about a $20 million position at Bitcoin ETF, and they said, oh, you see, look, this really smart guy has got Bitcoin. See, this is a good indication. Yeah, he manages over $100 billion. So if he has 0.2% of his portfolio in Bitcoin, that's hardly a high conviction trade. I mean, he barely owns it. It's an afterthought. I mean, you should look at the position that Tudor Jones has in gold and silver and mining stocks. So, I mean, the fact that he has tiny exposure to Bitcoin is actually more bearish because he's one of the most bullish guys out there in the hedge fund community. He's the one that came out with Bitcoin as the fastest horse in the race, yet he has a tiny position in Bitcoin. So if even the most bullish of the hedge fund managers barely owns any Bitcoin, I don't see how they were spinning this into good news. And I'm going to continue to advise the people who are watching my podcast, if you've got Bitcoin, you got to get off of that horse. You got to get on to gold and silver, or even just buy tech stocks, buy AI stocks. If you want to speculate, buy those. Bitcoin is dead money. And it's probably worse than dead money because dead money is just maybe going sideways. Your money is going to die, literally, if you leave it there. You've got this lull before the next storm. But while everybody is waiting for a big rise, the market's far more likely to drop. And I think once we crack the lows are around 58,000 or something like that, or a little bit below that. I think it's going to be a quick move down to 50,000. And if it cracks that, 25, 30,000, 20,000, I mean, you can be there very, very quick. And then you're going to start to trigger all kinds of selling when you get that kind of decline in the price. And again, as I mentioned on my podcast last week, it's been brought to my attention that hardly any of the ETF holders have thrown in the towel. Only maybe 10% redemptions. And just because they've been able to hold on for a 50% decline doesn't mean they're going to stay with it for a 60, 70, 80% decline. At some point, they're going to cry uncle here, and they're going to give up on this losing trade, and they're going to take their chips to another casino. So that is all coming up. Now, also, too, on the Iran news, which I spoke quite a bit about on my last podcast, but it really seems that we're moving away from the military confrontation. Even though we're moving another aircraft carrier out of Asia, I think that's our last one, and bringing it over to the Gulf. But we seem to be focusing now on economic sanctions. I read a post from Trump, and I was listening to Scott Bessent, and they're now talking about these economic sanctions that are supposed to hit this week. But they're supposedly going to be the most aggressive sanctions ever applied to any country in the history of the world. So we're not going to bomb them back to the Stone Age.